So let's continue with this illustration in this class. Discuss the taxability or otherwise of the following in the hands of recipient under section 56 class 2 subclass 10. All about taxation with respect to the gift received. Akhil Huff received 75,000 in cash from niece of Akhil. Okay, that is daughter of Akhil's sister. Daughter is a member, but son of daughter will not be a member. Okay, so here niece of Akhil falls under the other family member. So being the non-member, any amount received in excess of 50,000 will be taxable. So this will be taxable. As the value is more than 50, the entire 75,000 is taxable. Nitisha, a member of her father's Huff, transfer a house property to the Huff without consideration. So Huff and Nitisha. Nitisha also being the member, she transfers house property to the Huff without consideration. So as the money or gift received from the members exempt, nothing is taxable, because in case of Hindu undivided family members, any amount received as a gift from the members will not be taxable, or amount given to the members also not taxable from the Huff or to the members. Akshat received 100 shares of A Limited from his friend as gift on occasion of his 25th marriage anniversary. Marriage anniversary is not wedding day. Wedding day is the day in which the marriage happens, and anniversary is the celebration you do year after year. The fair market value on the date was 500 rupees per share. Okay. And also he received jewelry 45,000 fair market value from his nephew on the same day. So nephew being the relative, so not taxable. 100 rupees per share. How many shares are there? 100 shares. So 100 into 100, 10,000 rupees. Okay, nephew, what happens here? Nephew is not falling under the relative. Okay, so not falling under the relative. So this is 45,000, this is 10,000 rupees. If you add up these two, the value is more than 50. Then completely taxable. The entire 55,000 is taxable. The entire 55,000 is taxable. Jewelry 45,000. Share worth rupees 100 shares or rupees 100 each, 10,000. All these things are movable property. JP Das SB VDA. The overall value being 55,000. Then it crosses 50, so taxable. Kishan Huff gifted a car to son of Karta. Huff to members or vice versa, usually not taxable. Kishan Huff gifted a car to son of Karta. Okay, for achieving good mark. The fair market value of the car is 5,25,000. Okay. So car is not considered as capital goods, so not taxable, exempt. Yeah, anyhow, Karta's son is also member only. So in that angle also it is not taxable. In both angles it is not going to be taxable. This question is pretty interesting and requires more attention. So I may explain this in detail. Okay. Try to understand this illustration, one of the interesting illustrations. Mr. Hari, property dealer, sold building during his business to his friend Rajesh. Hari. Okay, Hari and Rajesh. Hari and Rajesh. sold a building doing his business to his friend Raj in automobile spare parts. Hari is property dealer. Rajesh is automobile dealer. Okay. Maybe builder. Maybe builder. Okay. Real estate. Real estate. So he sells the property. Okay. To Rajesh, who is a dealer in automobile spare parts for rupees 90 lakhs on 1/1/2025. Sale consideration being 90 lakhs. When the stamp duty value was 150 lakhs, on the same date, stamp duty value being 150 lakhs. The agreement was, however, entered 75 lakhs. Now we have to find out all these cases here. Okay, taxability in the case of Hari and Rajesh. Let's try to finish up this first of all. Now what happens here? For Hari, as is being the real estate owner, this house property is considered as what? Stock in trade. In case of stock in trade for Hari, section 43 CA will be applicable. As per section 43 CA, sale consideration being whichever is higher of, okay, stamp duty value as on the date of transfer or actual sale consideration. Provided whether the section 43 CA is applicable or not can be determined by this way. Stamp duty value is more than 120%, more than 110%. 110% of sale consideration. Yes, 90 plus 10%, 99. Stamp duty value is much higher than that. So definitely section 43 CA is applicable. As per the section 43 CA, sale consideration should be stamp duty value applicable as on the date of receipt of small amount in account pay for account manner. Apart from that, probably there is a written agreement to settle later on balance amount. The actual value in this case being 90. Between these two, 140 will be taken, and cost of acquisition 75 lakhs. So the difference between these two, 65 lakhs, is considered as PGBP. In case of Rajesh, any immovable property gets gift. No, we have what are the gifts we have? Money form and immovable property form and movable property form. In this case, cash in aggregate, if it is more than 50,000, then it is considered as taxable. Is that okay? We have studied already here. More than 50. Is that okay? This is the list you have to keep in your mind. As per that provision here, in case of movable property, the aggregate is more than 50. Okay, more than 50. Sorry, it's not equal. More than 50. Then that will be taxable. That will be taxable under income from other sources. In case of immovable property, you have to calculate independent assets. Okay, adequate, no consideration and inadequate consideration. No consideration, inadequate consideration. Two classification are there. Completely given at free or given at much discounted price. If it is completely given at free, then the value is more than 50,000 rupees. Then it is considered as gift and taxable. In case inadequate consideration, the worth may be 100 crores, but amount recovered is. So in this case, the inadequate consideration being 140 is the real value for the asset as per the stamp duty value provisions, but the actual amount paid is only 90 lakhs. The difference between these two is inadequate consideration. As this difference is definitely more than 50,000 rupees, naturally the difference between these two, 140 lakhs minus 90 lakhs, will be income from other sources in the hands of Rajesh. How much is that? 50 lakhs. Clear? Would your answer be different if Hari was a share broker instead of property dealer? Rather than real estate owner, if he is being the share broker, what happens? In case of share broker, this is not stock in trade, it becomes what? Capital assets. In case of capital assets, section 43CA is replaced with section 50C. Okay. So as per that provision, this ultimate profit 65 lakhs will be considered as long-term capital gain or short-term capital gain. Okay. 23, 24. Okay. Less than 2 years. So we can consider this being short-term capital gain. Like so, capital gains. This is not matter of capital gain only. Indexation is not available here. So only one difference. If it is being the PGBP, it will fall under section 43CA, and then the profit will be considered as PGBP. I do one slight corrections here. I missed to explain this properly. Here, crossed check is stated. Crossed check is equal to cash only. Okay, I stand corrected. I missed to explain this properly. Crossed check will be considered as a proper mode of payment only in one place. Bonus, I mean, employees bonus payable, commission payable, and other things. In all the cases, payment should be account paycheck or NEFT RTGS transfer. So because of this reason, we assume this 15 lakhs is disqualified. In this case, what happens? You can take only 150. So I just stand corrected. So all this value will be corrected with 150. Then here 60 lakhs. I stand corrected here. Here also 150, 150, 75 lakhs. I stand corrected. Sorry. You can make a note of it. So cross check. Cross check is equal to cash, like it's disqualified. It is disqualified. Mr. B transferred 500 shares of R Private Limited to Messrs. B and Co. on 10/10/24 for rupees 3 lakhs. When the fair market value was 5 lakhs. When the fair market value was 5 lakhs. So 500 shares transferred for 3 lakhs, but the fair market value is 5 lakhs. The difference between these two, 2 lakhs, which is more than 50,000. So it will attract the gift tax. Right. B to B and Co. Whose share? Share of R Limited. Okay. Sale consideration being 3 lakhs and fair market value being 5 lakhs. The indexed cost of acquisition of shares for Mr. B was computed at 4.45 lakhs. So hereafter we cannot do indexation also. Okay, you can replace this with simply cost of acquisition. Okay. The transfer was not subject to security transaction tax. Determine the income chargeable tax in the hands of Mr. B. So naturally what happens, unquoted shares. This is called as unquoted shares. Section 50C is all about what? Sale consideration is compared with the stamp duty value. Section 50CA is for what? Unquoted shares, where sale consideration is always compared with the fair market value, and sale consideration, whichever is higher, will be taken. Is that okay? So in this case, for B, what is the sale consideration to be considered here? Only 5 lakhs. So the difference between sale consideration and cost of acquisition is considered as capital gain in the hands of B. Capital gain in the hands of B. Okay. Long-term capital gain. But anyhow, today we don't have the indexation after 23rd July. We assume this way. So this may be unindexed like cost of acquisition. So the difference between these two, 55,000, sorry, 45,000 or 55,000? 55,000. You have to compare the difference. Inadequate consideration. This is inadequate consideration. Movable assets. So you have to compare the difference between fair market value as well as actual sale consideration or cost of acquisition paid. Okay, if it is more than 50,000, then automatically it is considered as gift, income from other sources. Fair market value being 5 lakhs, but the amount paid only 3 lakhs. So the difference between these two is 2 lakhs, which is more than 50,000. So the entire 2 lakhs is considered as income from other sources and taxable under income from other sources as a gift. Is that okay? So it seems to be double taxation, like B also loses the benefit, right? If you consider the difference between these two, huge loss will be there. That loss can be set off in some other income. So because of showing this 5 lakhs as a sale consideration, now his capital gain is 55,000. Otherwise, actually he faces loss. So he has to pay the tax on 45,000. And B should also pay the tax for the 2 lakhs, double taxation like. So in order to avoid the manipulations while transfer, so you have to genuinely transfer at the fair market value, and buyer should also genuinely purchase at this value. If it is not so, it's a manipulation. It's a manipulation. Is that clear? Hope now you'll be able to understand. So earlier one is all about 50C as well as 43CA. This one is all about 50CA provisions. 50CA provisions. Clear? Now, section 10 class 10D, exemption for life insurance receipts. Life insurance receipts. Already we referred this aspects in capital assets concept. Okay. By the time what are called as capital assets, I explained, especially if insurance receipt is there. Sometimes it may be considered as capital assets if it is not falling under section 10 class 10D actually. Okay. Now here, any sum received under life insurance policy, including bonus, is usually exempt. Clear? But of course we have the exemptions, exceptions. These are the 4 cases you have to pay tax. You have to pay tax, or it will be considered as income from other sources. You have to pay the tax, right? In case of keyman insurance policy, okay, payments under such policies are not exempt. You have to consider this being taxable. Keyman insurance policy. As per the keyman insurance policy, if employee gets the compensation, it is taxable under section 17. We already studied profit in lieu of salary. If the businessman or if the business gets, then it will be taxable under section 28. If there is no employer-employee relationship, not being the business, then automatically it is taxable under income from other sources. We have seen all these 3. So in case of any amount realized due to the insurance you made for a key person's scheme and insurance policy, on receipt is completely taxable. Next one is 3 predominant dates. If you pay the premium beyond a limit, then automatically any amount you receive after the maturity will be considered as taxable. 3 numbers are there. 3 numbers are there. I will explain that in detail at the last. Another one is, you may go for ULIP premiums, unit linked insurance policy. For that the premium is more than 2.5 lakhs. Policies issued on or after 1st February 2021 exceeding the threshold, then automatically on receipt it is going to be taxable. So 1/2/2021 later, if you buy any ULIP policies where the premium in the year is up to 2 lakhs, 2,50,000 or less than 2,50,000, on maturity the amount you receive fully exempted. So premium payable being 2 lakhs. On maturity, if you are getting sum assured, what about that? Exempted. So I am paying 2 lakhs premium year on year for 20 years, sir. Long-term premiums. Okay, you can do. Year on year 2 lakhs means 20 years, 40 lakhs invested along with the other bonus and interest. You may get 1 crore also, who knows. What happens that 1 crore are completely exempted. Suppose if the premium payment is say 2.5 lakhs, in that case also on withdrawal exempted. If it is 2.5 6 lakhs, even 1 rupee more than that, automatically on withdrawal, this is going to be taxable. How much is going to be taxable? The amount what you get minus the amount invested by you. The premium you are paying is the amount you invested year on year. Say you are investing 2.6 over 10 years period, you might have invested 26 lakhs by way of premium payment. On maturity, you are getting 40 lakhs. On maturity, you are getting 40 lakhs. The difference between these two 14 lakhs will be considered as taxable under income from other sources. Is that clear? If the premium per year is less than 2.5 lakhs or 2.5 lakhs, the sum assured value you are receiving, total value, including you paid the premium and accumulated revenue on that, fully exempted. If it is more than 2.5 lakhs, automatically what happens? To the extent amount you contributed, subtract from the amount received, then balance will be taxable. Now, this is all about ULIP policies. Sir, I have three policies, sir. Sir, 2 lakhs, sir. Another one is 25,000, sir. Another one is, say, 3 lakhs, sir. Another one is, say, again another 1 lakh, sir. What can I do? You can choose yourself to the extent of 2.5 lakhs. You can show this one and this one. These two will be within the limit, you know. These two beyond the limit. You declare that these are within the limit, so you can claim the exemption on withdrawal of these two, and but this will be taxable. This will be taxable. This 2.5 lakhs premium per annum, you know, is the limit for all the policies put together. It's not independent policies, all the policies put together. 4 or 5 policies also you can take. See, I have taken one policy for, okay, this will be the aggregate will start from 1st April 23 after this date. It's not immediately after this. 1st April 23 onwards, aggregate. 3 or 4 policies are taken, then you have to add all the 3 or 4 policies. If the premium payable for all the 3 or 4 is within 2.5 lakhs, completely exempted. If it is more than 2.5 lakhs, what you can do? To the extent of policies covered within 2.5 lakhs will be considered as exempted, balance will be taxable. For example, I have policy 1, policy 2, policy 3, policy 4. Here 2 lakhs and here 1 lakh, here 0.5, here 3 lakhs. Year 1, year 2, dash and 1 lakh and 0.5 lakhs, sorry, dash and 2 lakhs and 1 lakh 0.5 lakhs. And third year, fifth policy you entered for another 1 lakh. If these two are not required to be payable for any premium payable for that. See, in the very first year, you can claim how much? 2.5 lakhs. Now you can show these two. Next year also you can show these two. Next year, as this one is released, new policy is purchased, you know, all the 3 put together 2.5 lakhs, you know. So you will be claiming the exemption for third as well as fifth also later on. That's how you can aggregate based on year on investment. This particular content is very rare for your examination, but anyhow it is available as a question in CA instant material. I request you to go and watch that videos, okay? Try to solve this. So I have given the provisions, you can understand there with an illustration. ULIP, other policies premium being more than 5 lakhs. In case of ULIP, it is 2.5 lakhs, other policies more than 5 lakhs. Policies issued on or after 1 April 2023 exceeding this amount. Aggregate premium threshold applies across multiple policies. You may have 2 or 3 policies, you have to add all the 2 or 3 policies put together. But you invested, suppose the insured expired, and after the death, if his relatives are getting, legal heirs are getting, then this will be totally exempted. Okay. Exemption is not available in respect of amount referred from an insurance policy taken for disabled person under section 80DD. So, for example, Mr. A, he himself insured, and A's legal hire. A's legal hire. Okay. Clear? A's legal hire. A insured. The premium payable being 3 lakhs. You are aware about that the premium payment is more than 2.5 lakhs. On withdrawal, definitely it is taxable in the hands of Mr. A. But A died. Now the amount is received by legal hire of A. What happens here? Fully exempt. Fully exempt. Clear. Now, Mr. A, okay, disabled, physically challenged, okay, and for his health, Mr. B can invest or insure. Mr. B can insure. Insurance premium payable can be deductible as deduction under section 80 DDD, okay, in old tax regime. In old tax regime. Premium is paid for A, okay, for A's health with the insurance company. Suppose Mr. A died and LIC company releases the sum assured to Mr. B. What happens in this case, sir? In this case, this is taxable. Okay. Mr. A being the dependent disabled person, for his own safety and security, as he is not capable of living alone, he wants some moral support. Mr. B invests some money for A's health or insurance. Sometimes what happens, while investing, he can claim the deduction. Sometimes Mr. A died, sometimes later. So instead of Mr. A, now Mr. B, who invested or paid the premium, he himself gets, in this case, it is completely taxable. If he is being the disabled person, then automatically on receipt of any claim of the death of the dependent disabled will be taxable. Okay, clear? This one I guide you along with section 80DD. This one I guide you along with section 80C. So here what I guided is more than enough. We'll refer all these two sections along with the deduction chapter. Then you will be able to understand this one later on. Here you just understand 2.5 lakhs and 5 lakhs limit. That's all. Not more than that. This component I will teach along with the deduction chapter. Now, see, premium paid 4 lakhs. As this is being more than 2.5 lakhs, definitely taxable. On maturity, sum received being 6.5 lakhs. Sum assured or sum received minus premium paid overall period. 6.5 lakhs minus 4 lakhs. The difference between these two will be taxable under income from other sources. Okay. Clear? Any doubts here? That's all. So these are so almost we have completed all the things. We'll go for the practical questions. Final practical questions will start now. Discuss whether the following receipts are chargeable tax in the hands of the recipient. Prize money awarded to Arjun for participating in a motor car rally. Yes, taxable only. Income from other sources. Madhu received 10,000 from 6 friends of his, each from 6 friends. So every friend gives 10,000 means for 6 friends it is 60,000 more than 50. Entire 60 will be taxable. In case of monetary gift, over than 50 will be completely taxable. Ramesh received a plot of land from his father-in-law as gift on his marriage anniversary. Father-in-law relative not required to consider for the taxation. And marriage anniversary. Marriage anniversary is not marriage day, so it will not be considered. So any father-in-law being the relative, in that angle it is exempt, not taxable, not due to the marriage anniversary. Pramod purchased shares of Z Limited at 1 lakh from his friend. The fair market value of the share being 1.7 lakhs. Shares and bullion will also be considered as capital assets here. So here the consideration is paid but less than its worth. The lesser value 70,000, which is more than that, inadequate consideration being 70 is more than 50. That entire 70 will be considered as taxable. So overall taxable value being 1,40,000. Is that clear? Taxable under income from other sources. Let's now move on to the next one. Now, examine under which heads the following income are taxable. Rental income in case property held as stock in trade for 3 years. Okay, so this will fall under income from house property. Always let out property will be considered as income from house property only. Is that okay? Income from house property. Dividend on shares in case of a dealer in shares. Dealer in shares. Okay. Dividend will be considered as majority cases income from other sources only. But if he is treating this being the stock in trade, then it will be adjusted along with the PGBP. It's a rarest situation. In general, you can consider this being income from other sources. Salary received by a partner from his partnership firm, this will fall under PGBP only. Rental income of machinery will come under income from other sources. Winning from lotteries by a person having the same as business activity. Okay, playing gambling itself, he says my business. That will always be considered as income from other sources. There is no other way to escape. Okay, I cannot say this is my business, sir. Playing rummycircle.com from the morning to night, sir, cannot be said as your business. Salaries payable to member of parliament. Member of parliament is not being the employee for the government, so will be falling under income from other sources, not salary. Then definitely it will fall under income from other sources. Receipts without consideration. What is that? Receipts without consideration is nothing but gift will be taxable under income from other sources. In case of retirement, interest on employees' contribution, if provident fund is unrecognized, okay, employees contribution. So we already studied that in PF case. But if it is being unrecognized, then it will be considered as income from other sources only. Okay, employees contribution, interest on employees contribution will be falling under PG salary only, profit layer salary. But employees contribution is not taxable at the time of receipt from the unrecognized provident fund. But interest on such employees contribution will be falling under income from other sources. Go and refer the salaries head again. Rental income in case of person engaged in the business of letting out of properties. Rental income in case of a person engaged in the business of letting out of the properties. I'm letting out the property is assumed to be my business. Then it will be considered as PGBP. Okay. So earlier days, letting out of the property is considered as your regular business activity. Yet it will be taxable under only income from house property. Earlier, later it was converted into PGBP. And provided it should be in the articles of association and object clause. It should be a memorandum of association stating that objectives of the business is to let out the property and earn the rental income. If it is so, then it will be falling under PGBP. Is that clear? Hope you will be now able to understand the classification of income under the 5 heads. So, the following details have been furnished by Mrs. Hemali pertaining to the year ended 31st March 2025. Cash gift of rupees 51,000 received from her friend on the occasion of her Sastyapta Purti, a wedding function celebrated on her husband's completing 60 years of age. This was also her 25th wedding anniversary. These things will not be considered as marriage. So, automatically the cash gift worth more than 50 will be considered as taxable only. Taxable, the entire 51,000. On the above occasion, diamond necklace worth 2 lakhs was presented by her sister relative, so exempt. When she celebrated her daughter's wedding on 21/2/2025, her friend assigned in Mrs. Diwali's favor a fixed deposit held by said friend in scheduled bank. The value of the fixed deposit being 52,000 rupees. Now, what happens, daughter's wedding gift is given to Hemali's favor. It should be in daughter's favor, but it is not in the daughter's favor. It is her mother's favor, Mrs. Hemali. So it will be always taxable. There is a dispute. So JP Das SB, right? So here this FD is not stated anywhere as a capital asset. So there is a small dispute. Anyhow, I consider this is always being taxable only. Always being taxable. Taxable as it is for the daughter's wedding, that's why it is taxable. Other view, taxable as FD is not a property. If other view, not taxable as FD is not property. FD is not treated as a property anywhere. You can consider this being not taxable. But we cannot guarantee so that FD is equated with the cash. So in that angle, it is more than 50, no? So automatically it becomes taxable only. Clear? The other view, you can give a note, but in practical life, you cannot enjoy that benefit. Now, let's move on to the next one. Examine the following transaction in the context of Income Tax Act 1961. In the context of Income Tax Act 1961, Mr. B referred find shares of R Limited. I think we have completed this. This one is already over. We'll directly go for the next one. Mr. Chelian is employed in a company with a taxable salary of Rs 5 lakhs. He received a cash gift 1 lakh from Atma Charitable Trust registered under section 12 AB. So, Mr. T. Dillu, right, there T represents trust. If you are getting anything from trust, it's not going to be taxable. It's not going to be taxable. Is that clear? The second one is exempted. So with that, income from other sources topic is over. All the 5 heads completed now. So now we'll move on to the next chapter, clubbing of income. Now, under clubbing of income, what are we going to study? Usually what happens, Mr. A, Mrs. B, Mrs. A, Mr. A and Mrs. A. Mr. A gets around 1 lakh rupees as business income per month. Naturally, it comes around 12 lakhs. As per the new tax regime, 0 to 3 lakhs, nil tax. 3 to 7 lakhs, 5% is 20,000. 7 lakhs to 9 lakhs. 9 or 10? Okay. 7 to 10 lakhs, 5%, 10 percentage. 10 to 12 lakhs, isn't it? Yeah, 10 to 12 lakhs, 5, 10, 15 percentage. 30,000 is the tax. Now, Mr. A says and states that 50,000 is my income per month from my business. Another 50,000 rupees is nothing but the income from my spouse. Earlier, Mrs. A being homemaker, no tax, but Mr. A has to pay 70,000 rupees tax. By stating this way, A's gross salary is also, income also 6 lakhs, here also 6 lakhs. If it is less than 7 lakhs, validly, no need to pay any tax. The tax payable being only 0. So that's how the tax payable to the government can be cheated. Who is Mrs. A? Has no any qualification, just married to A. In order to avoid the tax liability of Mr. A, a portion of income is transferred to Mrs. A like they are cheating. Then government inquires, why do you get 50,000 in favor of your spouse? Will she be qualified for getting this 50,000 or not? No, sir, only to cheat this. Then automatically this 50,000 will be clubbed in Mr. A's account itself and it is going to be taxed in the hands of A. In order to avoid the cheating, these things are applicable here. Clear? Now, we have around 6 sections here, section 60 to 65. Okay. Section 60 is all about transfer of income without transfer of assets. Then in whose hand it will be taxable? Transferor hand. Is that okay? Mr. A lets out his own residential house property to Mr. B. Okay. And asking Mr. B to pay the rent to Mr. C. Owner of the residential house property being Mr. A only. As per the agreement, Mr. A demands Mr. B to pay the rent to Mr. C. Income is transferred without transferring the house property. Then automatically this rent will be taxable only in the hands of Mr. A. Clubbed in the hands of the transferor. Clubbed in the hands of the transferor. Is that clear? I am the owner of the property, but I am asking my user to pay the income to some third party. And now, Mr. A, Mr. B transfers the residential house property or some asset, any capital assets to Mr. B, asking that to enjoy this property as you wish until I ask it to return it. Okay, until I ask to return, until revoke. Revoke is nothing but I have the rights to get it back. Mr. A is the owner of the property. He hands over the property to Mr. B. He enjoys the possession of this for 2 or 3 years or until Mr. A wants it back. Then this income will be clubbed only in the hands of Mr. A. Mr. A. Mr. A transfers the house property or any capital assets to Mr. B. Okay. And Mr. A has the rights to get it back. Okay. Revoke. When? After B's death. Then in whose angle it is going to be taxable? Only in Mr. B's angle. So in this particular case, I have mentioned this particular point, revoke point. I transfer the ownership of my capital assets to third party, stating that you can enjoy until I ask it, until I revoke it. Then automatically any benefits of the capital asset is clubbed in my hand only, transferor hand. I transfer the capital assets and asking them to enjoy. Okay, you enjoy. After your death, I will take it back. After your death, I will take it back. In that case, what happens, any benefit of the capital asset is taxable only in the hands of the transferee. After the death, the asset again gets back to Mr. A. From the date onwards, it is going to be taxable only in the hands of A. Okay, you might have seen, right? Seems to be very different situations, but practically these things are happening. Okay, in the case also, Kalanyanam, I think, okay, a writer and storyteller became for lots of movies. See, Rajini wants to support his last years of life. So he gifted a residential house property, flats purchased and gave to Kalanyanam at free of cost. Okay, it's a gift like. Capital asset is transferred. Now the capital asset can be enjoyable by Kalanyanam until either his own life or may not be. I'm not sure. Okay. In some of my friends' case also, you enjoy the property until you leave. Thereafter, I will take. Okay. What happens the other way, sir? The transferor died much earlier than the transferee. That issue may be totally different. But transferee is almost 70 or 75, counting the dates and the transferor may be 30 or 35. So for the last few years of life, transferor wants to them to live peacefully, so giving some house property to enjoy. Okay, after death I will take it back. That way, lots of agreement I have seen in the life also. But by 31st year age itself, if the transferor died, what can be done? So that may also be happening, right? You just understand these are the scenario. Revocable transfer. In the first case, asset not transferred, only income is transferred. The second case, asset is transferred with a revocability. In that revocability, we have the two options. Revocable during the lifetime of the transferee, revocable only after the death of the transferee. Okay, revocable before the death of the transferee, then it is clubbed only in the hands of the transferor. But revocable only after the death means it is going to be taxable in the hands of Mr. B. Clear? Hope now you will be able to understand section 61. Okay. Now, Mr. A transfers the house property or any capital assets to Mr. B. Capital asset is transferred to Mr. B. Clear? Stating that irrevocable, I am not going to get it back from you hereafter. Irrevocable. Then who has to pay the tax for the capital asset? Mr. B. Complete right is given. I don't get it back from you anymore. But what happens sometimes later? Mr. B demised, and because of some reason Mr. B may return it back. Though it is irrevocable, but Mr. B wants to return. Okay, can be also. In that case, after returning, it is going to be taxable only in the hands of Mr. A. Until that period, it is going to be taxable only in the hands of Mr. B. Hope now you will be able to understand three sections. Section 60, 61, 62. 60 is all about Mr. A transfers the residential house property for the usage to Mr. B, but the rental income is given to Mr. C, rental income, and it is going to be taxable only in the hands of Mr. A, scenario 1. And in case of scenario 2, Mr. A, Mr. B, okay, where capital asset is transferred, stating that it will be revocable. It will be revocable, okay, or revocable after death. These are the two scenarios. In the first scenario, Mr. A is liable. In the second scenario, Mr. B is liable. This is section 60. This is section 61. And now let's go for the section 62. As per section 62, Mr. A, Mr. B. Mr. A and Mr. B. Okay. Mr. A and Mr. B. Mr. A transfers the residential house property, states that this is not going to be revocable. If it is not going to be revocable, then it is always taxable only in the hands of Mr. B. But after the death of Mr. B or some other reason makes the asset transferable back to Mr. A, then it is taxable only in the hands of Mr. A. Reassumes the power on that. So we hope now you will be able to understand three sections: 60, 61, 62 over. 63 is nothing but definitions. 63 is nothing but the definition. So what is called transfer, what is called revocable transfer, everything is defined. That already explained. Okay. So we have completed 4 sections up to now. Clear? Transfer of income without transfer of the assets, revocable transfer of assets after death. So all these things are explained. I have to discuss in detail this particular sections. Beforehand, we'll try to finish up some illustrations covered up to this section. Now, Mr. Bachchan has transferred through a duly registered document the income arising from the godown to his son. Okay, godown is given to whom? Some third party, and the revenue for this godown is given to Bachchan's son. Right. So ownership is not transferred, only the income is transferred. In whose hands will the rental income from godown be charged? This is going to be clubbed in the hands of Mr. Watson, and it's going to be taxable only in the hands of Watson as per section 60. Clear? Now, Harish has transferred certain securities owned by him to a trust for his married sister Harsha. Okay. Harish to Harsha. What's that? Securities, capital assets. He has the power to revoke, this one being revocable. On 31st March 25, he revoked such a trust. Actual transfer happened on 1/7/23, revoked on 31st March 25. Income accrued for the previous year 23, 24, 24, 25, these 2 years. Okay, respectively, and such income is received and enjoyable by Harsha. So, income is received by Harsha and she enjoys during these 2 years. From the date of transfer to this date, Harsha enjoyed the revenue 1,20,000 and 1,50,000. The capital assets being securities of Harsha transferred to Harish to Harsha, and now she enjoys the income from that asset. Property is also now in the hands of Harsha only. Property is also transferred, the benefit is also enjoyed by Harsha. While transferring, a small condition is there. What is the condition? Whenever Harish needs, then Harsha has to transfer it back. So that's a revocability. In case of revocability, always remember this income will be clubbed only in the hands of Harish as per section 61. Revocable. Is that okay? In the earlier case, property not transferred, only income transferred. In this case, property itself transferred and transferee can enjoy the revenue provided the transfer is revocable. The transfer is revocable. Whenever the transferor wants it back, it should be returned. So then automatically it is going to be taxable only in the hands of Harish. Only in the hands of Harish. Is that clear? Raja transferred his property on 1/4/23 to Rani. Okay, Raja to Rani on 1/4/23 property, house property. He will take the property back from Rani whenever he requires. Then it is revocable mode. Raja was in need of money on 1/4/24 and he took back the property from Rani. The property yields annual income 2 lakhs. Whatever it may be, completely it is taxable only in the hands of Raja. Because whenever Raja wants, then he can take, means automatically it is revocable. Automatically it comes under revocability only. Seema transferred 1/4/23 her property to Neema 1/4/23 house property for the lifetime of Neema, with a clause that after death of Neema property shall be back to Seema. So it is also revocable, revoke only after death. Okay, Neema died on which date? Death happens 1/4/24. Seema has not taken back the property till 31st March 2025. Property yields annual income. So in this year, 2 lakhs, 1 lakh is the income. After the death, until repossessed, again 1 lakh is also income generated. As per the transfer provision, it's revocable only after the death. It is taxable only in the hands of Neema until Neema's death. Neema's death happens this period, so this 1 lakh will be taxable in the hands of Neema. Thereafter, after the death of the Neema, by default condition, it is now the property of Seema only. Whether she takes it possession or not, automatically this 1 lakh is now taxable only in the hands of Seema. Clear? Seema. Is that clear? So you cannot claim the tax from Neema after her death. Okay, hereafter it is enjoyable only by Seema. Next. Section 63 also completed. Now, we'll see this clause. Section 64 clause 1, subclause 2, spouse and substantial interest case. Spouse and substantial interest case. Okay. So I have to discuss that in detail here. Now, section 64 clause 1 subclass 2, then 4, 6, 7, 8. From here to here, the logic will be the same. Only this one you have to study separately. Spouse and substantial interest cases separate. 4, 6, 7, 8 will be the similar pattern. I'll finish up 4, 6, 7, 8 in single shot. Let me try to finish up this one first of all. Section 64, class 1, subclass 2. Now, substantial interest. What is called substantial interest? Already we studied holding more than 20% PSR or shareholding will be considered as a substantial interest as a family owned. Okay. Now, partnership firm. Partnership firm. Where Mr. A, Mrs. A. Mr. A holds PSR being more than 20% or 20%. 20% or more than 20%. Then Mr. A is considered as holding substantial interest in the partnership firm. Profit sharing ratio. In that case, Mrs. A may be implied here. Mrs. A may be implied. Okay. For that, salary is offered. Implied and salary is offered. Okay. Salary, remuneration, bonus, commission by whatever name may be. Okay. Now, the salary being 1 lakh. Now, the question is, what happens this 1 lakh, sir? Is it going to be taxable in the hands of Mrs. A or taxable in the hands of Mr. A? It is going to be taxable in the hands of Mr. A when, if Mrs. A has no qualification for the job. She got the job only because Mr. A having the controllable interest in firm. So as Mr. A has more than 20% rights in the firm, he demands the management to appoint his spouse. Will come now and then and get salary decently. Most of the cases. Right. So Mrs. A gets a salary only because of Mr. A's influence. Automatically it's going to be taxable only in the hands of Mr. A. No sir, Mrs. A also has a qualification. Then this 1 lakh will be not required to be clubbed, only it's going to be taxable in the hands of Mrs. A. So will it be the other way, sir? If Mrs. A has more than 20%, Mr. A gets the employment without any qualification. That time also is going to be clubbed only in the hands of Mrs. A. Mrs. A. Mr. A and Mrs. A both put together holding more than 20% shares. Both are employed there without qualification. What can we do, sir? What can we do? Should be clubbed in the hands of Mr. A or Mrs. A, whose income is higher before adding this income. Before adding this income. Mr. A's income is 5 lakhs other than this salary. Mrs. A's income being 2 lakhs. So here 5 lakhs, that 2 lakhs means it should be clubbed only in the hands of the income earner who earns 5 lakhs. Is that clear? Joint holding. So, income of spouse is taxable in the hands of the assessee if the following conditions. Income should be in the nature of salary, commission, bonus. Such remuneration should be received from the concern where assessee has substantial interest. Substantial interest is held by assessee himself or with relative. Himself or with relative. Relative means himself, spouse, father, mother, brother, sister, and lineal ascendant descendant will be available here. Okay. Maybe salary, commission, and bonus. Exceptions. It is not required to be clubbed. When the remuneration is received by spouse, where spouse possesses technical and professional qualification, and the income is for the application of that technical profession experience only. Due to the reason is the salary is payable, then it's not required to be clubbed. Not required to be clubbed. Is that clear? Hope now you'll be able to understand. So without qualification, spouse gets a salary from the partnership firm where Mr. A being the owner or having the rights to claim more than substantial interest, more than 20% PSR or more than 20% shares. Is that clear? Hope now you will be able to understand. Now, Mrs. Sukanya is a qualified cost accountant. Okay. Mrs. Sukanya. Okay. Yeah. So, Mrs. Sukanya is a cost accountant. She is salary employee in a firm of cost accountants. Cost accountants firm. She employed here. In which Mr. Ashok, husband, is a partner. Mr. Ashok share in the firm is 10%. Mr. A has 10% and his younger brother holds 10%. Okay. If you add up these two, it is 20%. Then it is substantial interest only. Sukanya draws a salary of rupees 18,000 per month. This is however paid in kind, not in cash. Mr. Ashok income by way of sitting fees from the various boards of the companies in which he is an independent director, 3.5 lakhs. So Mr. Ashok, income from other sources. Being the director, if he gets sitting fee, that will be taxable under income from other sources only, not under any other 4 heads. So it is taxable under income from other sources. What about Mrs. S? Will Mrs. Sukanya's income be clubbed? This 18,000 to be clubbed here? Definitely not so. Not required to be clubbed because she has the qualification. This firm is also cost accountant firm and she is also cost accountant qualified. And her salary is also justifiable because of her qualification and experience. No need to consider this being to be clubbed. Alright. So 18,000 into 12 months minus standard deduction 75,000 can be deducted. Clear? Hope you will be now able to understand this. Shall I move on to the next one? Clear? The following details of Mr. X income and his wife for the assessment year. Okay. Income from own business or professions, income from other sources, interest received from Z and Co, salary received from Z and Co. Mr. X and Mrs. X are partners in Z and Co. Both are being partners. Each having 10%. If you add up, then 20% no. So it will be considered as substantial interest. So here Mr. X as well as Mrs. X both are having. Then in whose account is going to be clubbed? We are talking about only salary. Rest of the things will not be required to be clubbed. Now the question is it going to be clubbed in the hands of Mr. X, or is it going to be clubbed here? Forget about these salaries from the partnership firm where these two are having substantial interest. Find out the other income first of all. The other income, Mr. X, Mrs. X, PGBP income, 1,20,000, 90. Income from other sources, 2,10,000, 1,10,000. Interest is not considered for the salary bonus remuneration, commission. Okay, but interest will not part of that, so you can take that directly, 20 and 4,10,000. Now leaving that salary, what's the total income? 3,50,000 and 6,10,000. From this, it is very clear Mrs. X's income other than this partnership firm income is higher. So Mr. X income is going to be clubbed in Mrs. X account. Now what about the salary from the partnership firm, sir? This 84,000 will be taken as it is, and Mr. Any income from the partnership firm will be PGBP only, not salary. Now what is the total taxable amount? For Mr. X, it is 3.5 lakhs. For Mrs. X, 7,90,000. This one is due to clubbing provision. This is direct provision. Is that clear? Hope now you'll be able to understand. Shall I move on to the next one? Mr. and Mrs. X working in A Limited without possessing any qualification. So in that A Limited, X and Mrs. X both will have 21% shares, so substantial interest. Salary from A Limited is also there. Okay, this will be clubbed later on. Okay, after finalizing to whose account it is going to be clubbed. Case 1, other income is higher in whose hand? Mrs. X. So these two will be taxable only in the hands of Mrs. X. How much is that? 1,80,000 rupees. In this case, the other income being Mr. X 90 higher, so you can add Mr. X account that 1,80,000. Okay. Now there is no other income, then what happens? You no need to apply the clubbing. 120 will be taxable only in the hands of Mr. X, and 60 is taxable only in the hands of Mrs. X. See, first scenario. Before we add the taxable salary from A, other income is the deciding factor. In the very first instant, the other income is higher for Mr. X. So the entire salary is now taxable only in the hands of Mrs. X. In case 2, Mr. X other income is higher, so these two are taxable only in case of Mr. X. Last case, there is no other income. Now clubbing will not be applicable. Directly you can show the income in their respective hands. See here, where both husband and wife have substantial interest in the concern and both are in receipt of remuneration from the concern. Remuneration will be included in the total income of husband or wife whose total income excluding such remuneration is greater. Where such income is included in the total income of either spouse. For example, in this year we included in Mrs. Income, clubbed in Mrs. Income. Year after year, you have to continue to include the same. Okay, you no need to rechange. The clubbing will be applicable very first year. Thereafter, you have to club in the same head, same assessee year after year, unless proven the other way. Okay, where such income is included in the total income of either spouse, any such income arises in the subsequent year will not be included in the total income of the other spouse. Will be clubbed in the same assessee's name, unless other assessing officer satisfied. Is that clear? So we have completed the section 64 class 1 subclass 2 provisions. Substantial interest case. Is that clear? Now, so we have completed the second one. Now I am going to finish up 4, 6, 7 and 8 all put together in single explanation itself. Now, Mr. A transfers the assets to Mrs. A. Okay, or daughter-in-law. In both the cases, Mr. A transfers the asset to Mrs. A or daughter-in-law. No adequate consideration or inadequate consideration. Adequate consideration. Capital asset is transferred. Then will be clubbed, the income generated in that will be clubbed only in the hands of Mr. A. Or the asset is transferred to any person or any association of persons. And capital asset is transferred to any person or association of person. This any person or association of person indirectly helps Mrs. A or daughter-in-law. In that case also the income is clubbed only in the hands of Mr. A. Is that clear? 4 aspects are over. Section 64 class 1 subclass 4 spouse income from asset transferred without adequate consideration is clubbed only in the hands of the transferor individual. To son's wife, daughter-in-law. Son-in-law is not there, daughter-in-law. Okay. Then taxable only in the hands of the mother-in-law or father-in-law. Okay. So hope you will be now able to understand. This will be class 4. This will be class 6. This will be class 7 for Mrs. A. This will be class 8. All the 4 classes explained with this small diagram. Directly helping Mrs. A or directly helping daughter-in-law are routed through any person or AOP for the benefit of daughter-in-law or Mrs. A. So you know that Mrs. A, isn't it? And daughter-in-law. Mrs. A and daughter-in-law will be applicable due to the marriage, right? What's that, sir? There is a confusion. The transfer happens before the marriage or after the divorce, live apart. In these cases, these things are not required to be clubbed. Right. Clear. It means that husband and wife relationship and daughter-in-law as well as mother-in-law or father-in-law relationship should exist at the time of transfer of asset and generation of income. These two should happen only the relationship exists at the time of transfer of assets as well as at the time of generation of income. Else, the clubbing provisions will not be applicable. Clear? Hope now you'll be able to understand this provision. Okay. Clear. Let's try to solve all these provisions here along with some other items. Now, what is the difference between that section 61 and 64, sir? Section 61 applies to revocable transfers only, can be made to any person. Okay, already we have studied. 64 also same, like asset is transferred, right? In the benefit, for the benefit of spouse and daughter-in-law. So both are revocable or irrevocable. This section 61(4) is also about revocable or irrevocable. Restricted to transfers made by individuals to whom? Spouse or daughter-in-law. Here any person. This is the main difference between 61 and 64. Rest of the things are similar. Right? Here relationship very, very important. Okay. Spouse relationship or daughter-in-law relationship very important. So asset transfer to spouse, but this one is not applicable for the residential house property transfer. Why? If husband transfers the residential house property for the benefit of his spouse or minor daughter, that will be covered under section 27, income from house property, deemed to owner. Okay. So by the time I told, I'll just reconnect this along with the clubbing chapter later on. So later on, we forget about you, sir. Then how can we remember that provision you taught earlier? Huh? Anyhow, you can go and recap those things. Section 27, deemed owner. Income from house property will be taxable in the hands of the owner or deemed owner. Mr. A, being the owner, transfers a residential house property to his spouse, will be clubbed only in the hands of the transferor as per section 27, deemed owner. Deemed owner. Though the house property is registered in spouse name, yet though your spouse may be the registered owner, but you are being the enjoying owner, so you have to pay the tax. Okay. Transfer to minor child or spouse, wife. Leaving that, other things are covered here. If any individual transfers any assets to his or spouse without consideration or inadequate consideration, then income from such asset is clubbed in the hands of the transferor. Exceptions. What is the exception? Transfer is made under agreement to live apart, divorce case. If relationship of husband and wife does not exist either at the time of transfer as well as accrual of income. While transferring the assets, there is no relationship between these two, husband and wife, and thereafter got married. After that, income generated in the hands of spouse, of course, not required to club. Not required to club. Is that okay? Similarly, if a house property is transferred by an individual to his spouse or minor child, not being a minor daughter, minor daughter will not fall into this case. Okay, minor son, minor daughter will not be falling under the not being minor daughter. For without or inadequate consideration, then such individual is treated as deemed owner as per section 27. Clubbing under section 64 is not applicable, where section 27 is applicable. Provisions are same, but section 27 will be applicable rather than 64. So 4 is over, 5 and then 6, the same, asset transfer to son's wife. Okay, the relationship of father-in-law, mother-in-law and daughter-in-law should subsist both at the time of transfer or at the time of accrual of income. Accrual of income. Both at the time of transfer of the assets as well as accrual of income, the relationship should exist. Now, Mr. Vishal gifted a sum of ₹3 lakhs to Miss Mirinal on 1/4/24. Miss Mirinal got married to Vishal's son on 1/6/24. So, on this date only, Mirinal becomes daughter-in-law. Okay, at the time of transfer, she is not being the daughter-in-law. Mirinal earned it. So, here 3 lakhs is transferred by the time father-in-law and daughter-in-law relationship does not exist. After the marriage, Mineral earned an interest of rupees 22,000 from this gifted amount for the year ended 31st March 25. For this period, daughter-in-law makes a profit of 22,000. Now, can we club this in the hands of Vishal? No, sir. At the time of transfer of the assets, there is no relationship between these two. Okay, daughter-in-law and father-in-law relationship not there. So, at the time of transfer as well as at the time of accrual, both the time that relationship should exist, else clubbing provisions will not be attracted. So, it's taxable only in the hands of Mirror. Okay, hope you will be now able to understand. Now, so almost we are going to finish up the chapter. One aspect we need to, one or two aspects need to be covered in detail. Rest of things are almost over. Okay, this is one of the smallest chapters. So what are the contents over? 60, 61, 62, 63, 64 class 2 over, and 4, 6, 7, 8 are similar. In case of minor child and half case, you have to study in detail. Clubbing includes not only income, includes loss also. Clubbing of loss also be included. Even liability should also be included. Liability, asset is included, no, similarly liability should also be includable. Income is also includable, loss also be includable. Clear? Okay. Now, some special provisions before we go further. Clubbing applicable even if the transferred asset is converted into some other form. Then also clubbing is includable. Clubbing under the same head in which it is earned. The same head. No clubbing in case of income earned using the income of the transferred asset. Let me explain all the three. Mr. A transfers the asset to Mrs. A. Capital assets transfer. Probably debenture transfer. Debenture transfer. Worth rupees, say 100 lakhs. In that, Mrs. A gets rupees 10 lakhs being interest. 10 lakhs being interest. Now, come on, tell me. This interest is considered as what? Income from other sources. Transfer of debenture without consideration. There is no consideration transfer. Then automatically, this income will be clubbed only in the hands of Mr. A, also named as income from other sources. Income from other sources. Okay. Later on, Mrs. A sold the debenture and gets the house property. Okay. Debenture has gone and house property came. Is that okay? Debenture sold and house property received for 110 lakhs. How much? 110 lakhs. Sale consideration being 110 lakhs. Cost of acquisition of the debenture being 100 lakhs. 10 lakhs is capital gain. 10 lakhs is capital gain. 100 lakhs worth the debenture sold for 110 lakhs. Using 110 lakhs, she purchased the residential house property. Is that okay? 100 lakhs debenture sold for 110 lakhs means there is a gain 10 lakhs. This 10 lakhs is taxable only in the hands of Mr. A. Mr. A. What? Capital gains. Capital gains. Not interest. No, it's a capital gain. Later on, by letting out the residential house property, Mrs. A gets a rental income. Okay, tenant and gets a rental income. Rental income in this case being 22,000 rupees or 2,20,000 rupees rental income. How can we treat this, sir? In case of rental income, rental income to the extent of original value of the assets transferred by Mr. A to Mrs. A, 100 lakhs. Out of the overall amount spent for purchasing the residential house property being 110 lakhs. To that extent, 100 lakhs divided by 110 lakhs. How much is that? I think it is 2 lakhs. This 2 lakhs will be clubbed only in the hands of Mr. A as income from house property. What about the remaining amount, sir? Out of 110 lakhs, for the 10 lakhs, 20,000 is there, no? This will be taxable only in the hands of Mrs. A, named as income from house property. Okay, let me explain this concept in detail. Asset, what the asset transferred from Mr. A to Mrs. A, keeping the asset, any income generated will be clubbed directly in the hands of Mr. A. Okay, very simple. If the asset is converted into another form, after the conversion, any income generated from the newly converted asset should also be addable only in the hands of the original transferor, husband, son. While converting, if there is any capital gain, that capital gain also be taxable only in the hands of the transferor as in capital gain only. The same hit. Provided doing this operation, if there is any income generated, that income also be reinvested. Here, the amount spent for purchasing new house property is nothing but 100 lakhs originally given by Mr. A, another 10 lakhs income earned by Mrs. A. Okay, for this 110 lakhs, she purchased the residential house property. For this 110 lakhs, she earned 2 lakhs 20. To the extent the amount given by Mr. A, now you can calculate using the same proportion, which is 2 lakhs. Another for the 10 lakhs of Mrs. A's profit earned, the rental income being 20. This will be considered as income earned from the converted property. This one is called income earned from the income generated from the asset originally transferred from Mr. A. This is nothing but capital asset, converted capital assets, and income. This is nothing but capital assets from the gain. Capital gain is generated. From that capital gain, we generate the income. Okay, this is not the original capital asset. This is income of income. Income of income is not required to be clubbed. This is nothing but capital asset, converted capital assets. For that converted capital assets, income will be clubbed. Any income generated, further income, if you are reinvesting and earning any income, not required to be clubbed. No clubbing in case income earned using income of the transferred asset. This is nothing but income of the transferred asset. Using the 10 lakhs, this 20,000 income is generated. This is nothing but income of income generated from the transferred asset. It's not required to be clubbed. Not required to be clubbed. Okay. Clear? Now, yes, now first one you see here, clubbing applicable even if the transfer asset is converted into some other form. Debenture converted into house property. From the converted house property, income generated is clubbed. While converting, if there is any gain generated, if that gain is also used for income generation, income generated from such gain is not required to be clubbed. While clubbing, if it is being the interest, it will be considered as interest. If it is being the dividend, it should be considered as dividend. If it is being the rental income, it should be considered as income from house property. If it is capital gain, it should be capital. The same head should be clubbed. Hope now you'll be able to understand the special provisions also. Clear? Mr. A gifted debentures 1 lakh to his wife. She received 10,000 interest, which she invested and earned 1,000 rupees. So 1 lakh debenture. From the debenture, 10,000 interest is earned. And which she reinvested. That again another 10,000 reinvested and gets another 1,000 rupees. This is nothing but interest on interest earned. Okay, this will be clubbed. This one not clubbed. Not clubbed. Is that clear? For the original transfer 1 lakh, any interest you receive year on year will be clubbed only in the hands of the transferor. Any income subsequently you receive, now on that any income subsequently reinvestment, after reinvestment, if you are getting any income, not required to be clubbed. Not required to be clubbed. Next. Mr. X gifted 1,000 shares of a non-domestic company worth rupees 6 lakhs acquired on this date to Mrs. X. Okay. Cost of acquisition being 6 lakhs. Out of natural love and affection, on 31/1/25, Mrs. X received dividend 60,000. So she gets on 1/2/25, Mrs. X sold such shares for rupees. See, now this is the first investment. This is the original asset, and for that dividend is received. This dividend is for the original asset transfer, so it will be clubbed only in the hands of X. Step number 1. Later on, Mrs. X sold such a share for 10 lakhs. Now, sale consideration of share being 10 lakhs, cost of acquisition being 6 lakhs. The difference between these two 4 lakhs is the capital gain. This capital gain should also be clubbed in the hands of X. Now she has how much in her hand? 10 lakhs rupees. 6 lakhs is the original asset value transfer from X. Another 4 lakhs she earned. Income earned and reinvested means it's not going to be clubbed. Okay. Now, show tax treatment if on 1/2/25 Mrs. X invested 10 lakhs 60,000 in cases. Now she invested 10 lakhs 60,000 rupees on house property. So how much she has in her hand? Sale consideration 10 lakhs plus dividend 60,000 rupees. Overall she has 10 lakhs 60,000 rupees in her hand. Original asset transfer being only 6 lakhs, balance being 4.6 lakhs is nothing but income of the original asset. This is original capital assets. For this capital assets, this 4.6 is earned. No, this is already clubbed. This is already clubbed. Thereafter, for the 10.6 lakhs, any income generated to the extent of 6 lakhs only clubbed to that proportion. Balance 4.6 lakhs worth the income generated out of the house property will not be clubbed. Now, a house property from which rent accrued in the previous year 24/25 being 53,000. Now, scenario 1. $53,000. Come on, tell me. Minus house property rental means 30% flat deduction is there. Balance, what is the taxable income? 3,700. Now, what are the incomes are going to be clubbed in scenario 1? Mr. X, Mrs. X. Original dividend will be taxable only in hands of Mr. X. How much is that? 60. And capital gain 4 lakhs also taxable only in hands of Mr. X. Income from house property 3,700 100, no, this 3700 earned for 10.6 lakhs. Out of 10.6 lakhs, 6 lakhs is related to Mr. X original amount transferred. So into 6 by 10.6, how much is that? That will be clubbed in the hands of Mr. X. I think it is 21,000. Balance 1600 will be taxable only in the hands of Mrs. X. Any income generated using the income subsequently, if she gets any income, not required to be clubbed. For the original amount transferred, for that any income generated, even after the conversion, any income subsequently generated will be clubbed. Will be clubbed. So always remember, for the income earned, what is the total amount invested? In the total amount invested, what is the original value transferred by X to Mrs. X? 6 lakhs. To that extent only comparable or clubbed. Scenario 2. Newly formed partnership firm and contributed initial capital, interest received means taxable portion on such contribution being 13,250 and share of profit being 20,000 rupees. Share of profit, partnership firm's profit share, it's not taxable. Only interest component is going to be taxable. How? In this case, Mr. X, Mrs. X. Dividend will be taxable only in the hands of Mr. X. Capital gain taxable only in the hands of Mrs. X, Mr. X. And interest from partnership firm. 13,250, you can calculate this way. 13,250 into 6 lakhs divided by 10.6 lakhs, which is going to be clubbed here. How much is that? 7,500. Balance 5,750 not required to be clubbed. Clear? Third scenario. A newly started proprietorship business and contributed capital, profit accrued. So here Mr. X, Mrs. X. Dividend is taxable only in the hands of Mr. X, and capital gain is taxable only in the hands of Mr. X. But what about the PGBP income? 42,400 earned using 10.6 lakhs. Out of that, 6 lakhs only the amount originally transferred from Mr. X to Mrs. X. 6 by 10.6 lakhs. What is the value? 24,000 is clubbed. Balance not required to be clubbed. Hope you will be now able to understand the clubbing provisions here. Remember these points. Transferred assets, originally transferred assets, from there any income generated, clubbed. If the transferred assets converted into new form, then also the new form's revenue from the new form asset will also be clubbed. If there is any income generated, reinvesting the same income, if any further income generated, not required to be clubbed. These are the 3 points. Clear? Shall I move on to the next one? Section 64, class 1A. Section 64, class 1A. Minor children. Minor children. Very simple. Whatever the income earned by the minor children will be clubbed only in the hands of the parents. father or mother. Okay. Before clubbing, whose income is higher, just find out in that parent's account, it should be clubbed. Once it is clubbed in the hands of either father or mother, thereafter continue to club in the same, unless assessee satisfies or wants the other way. Is that okay? Very simple. The same like you have to club. Okay, only in the hands of father or mother. Clear? In case of minor. In case of minor. But due to the divorce after the leave apart reason, if the child lives with father, then it is clubbed only in the hands of father, or lives with mother, then mother's hand it will be clubbed. Very simple concept. Provided if the income is earned by the minor child due to the minor child's skills and talent, super singer and all. So I want to teach my daughter about stock market, but there is no such provision. Okay, I just thought about why don't we have that stock market investment to be taught at school level. It's very interesting, right? Though she earns money, it will be clubbed with the father's son. In US, no, it will be habitual from their own third standard or fourth standard. You can start invest in stock market. Like Warren Buffett started investing by at his age fourth and fifth, at the study time of fourth and fifth itself. Right. So my class is here. There is no any magic with the door. Huh? Understand? Right. See, you can learn, you can invest, and you can earn money, but it should be clubbed with the parents only. I cannot prove. Okay, but super singer and inborn talent, of course, not required to be clubbed. Income earned by minor child would be clubbed in the hands of parent whose income is more before clubbing minor's income. Under the following situation, income of minor child would not be clubbed. Income earned by minor child through manual work, skill, talent, or specialized knowledge and experiences. Or if the minor child is suffering disability referred under section 80U, disability, okay, some physical disabilities there, then clubbing is not required. While clubbing, 1,500 can be deductions claimable, exemption can be claimable, 1,500 per child. Okay. Provided old tax regime. The relationship of husband and wife does not subsist, then automatically the child's income should be clubbed in the parent's hand with whom the child lives. Right, number one. Number two being 1,500 exemption will be given if you are shifting out of the default tax regime. Okay. Now, once clubbed the minor's income with a parent, then you have to continue to club in the same hand year after year. The clubbing provisions are attracted even in respect of income of minor married daughter. Minor married daughter also. Okay. Minor married daughter. Okay. Don't get confused with that statement here. Focus on your exams. In your studies. Right. This is now illegal. Right. Okay. Sir, this option is better than focusing CA and CMA exams, sir. Okay. Now it is illegal. Minor married daughter. Earlier it was there. Right. See, in case of residential house property, the case is totally different. Here, the case is different. You have to be careful here. Child includes stepchild and adopted child too. Stepchild and adopted child too. Is that clear? This is the case you have to understand under section 64 class 1A. Let's now start with some illustrations here. Mr. Y, who is a physically handicapped minor suffering from a disability of the nature specified in section 80U, earns bank interest of rupees 50 and 60 and marking bags manually by himself. Bank interest 50, 60 is manual work. The total income of Y shall be computed in the hands separately. Whose hand? Both will be taxable only in the hands of Y, not required to be clubbed. Agricultural income in India earned by Master Sohan. What about the liability? Actually, agricultural income is also fall under manual work, but anyhow it requires to be clubbed only because it's given in a case law of Suresh and the Talera versus Union of India, so you don't have any argument against this. In case of agricultural income, though it may be manual work of the child, yet it will be clubbed with the parents only. Other than that, any manual work will not be required to be clubbed. Rishi, aged 12 years, earned 10 lakhs during the previous year 24-25 for acting in a feature films. The said sum was kept in a FD in his name. The interest earned on FD being 50,000, in whose hands shall be the two income included. This the 10 lakh is due to what? Acting, special skill. This 50,000 is not due to the acting, so it will be clubbed only in the hands of the father after subtracting 1,500 in case of old tax regime. Otherwise, the entire 50,000 will be clubbed in the father's hand. Okay. Now let's see. Mr. Daga is a trader. Particulars of his income and those of the members of the family are given below. Income from Daga, Mr. Daga. PGBP income, 90,000. Salary derived from an education institution by Mrs. Daga. She is the principal of the institution. Principal of the institution. Okay, Mrs. Daga. Salary income. Assume this is being the computed, means standard deduction 75,000 already subtracted. This is your assumption. Interest on company's deposit derived by Master Deep Daga, minor son. Those deposits were made in the name of Deep Daga by his father's father about 6 years ago. That's not a matter for me. Interest should be clubbed only. This is going to be clubbed. In whose hand? Daga or Mrs. Daga? Wait. We have to find out the income of these two parents independently before clubbing. Find out the whose income is higher. In those income, it should be addable. Now you keep it pending. Receipts from sale of paintings and drawings made by minor Dibali Daga. So paintings skill, so not required to be clubbed. It is going to be taxable only in the hands of Dibali Daga. Okay. All the names are very interesting. So here PGBP income or income from other sources. If she does this as a profession, it will be falling under income from other sources. Means PGBP, or it will fall under income from other sources. Casual income like 60,000. Income by way of lottery earning by Master Dipendra Daga. Lottery always be clubbed. Okay. So these two are going to be clubbed only in the hands of the parents' income, whose income is higher here. Mrs. Daga has only 50. Mr. Daga has 690. So you have to add here. Deep Daga. 12,000 rupees. You can subtract 1,500 in case of old tax regime. Then the value being 10,500. And Dipendra Daga. 26,000, and you can subtract 1,500 in case of old tax regime, 24,500. So the taxable income of Daga in this case being 1,25,000, and Mrs. Daga 50 and Dibali Daga 60. Okay. Per child. Yeah, there is no limit. Any doubts here? I had to cover two aspects, one general concept. With that, this entire chapter will be over. Only two aspects. One is huff, another one is amount received from spouse to be invested in the business. Two aspects. Only two aspects. With that, the entire chapter will be over. Finally, a small additional learning for cross transfer. Once we cover all these things, that chapter will be over. Shall I move on to the next one? So what are the things are covered here? See, the entire chapter is falling under only one page. 60, 61, 62, 63. In 64, spouse and substantial interest, most important one, very often we can expect. 4, 6, 7, 8 can be clubbed as a single one. And now we have completed minor child case. So now we'll be moving on to the last one, 64 class 2, member to Huff. Member to Huff. Hindu undivided family. Okay. Mr. A being one of the member transfers self-earned property to Hindu undivided family. Mr. A transfers self-earned property to Hindu undivided family, or mixed with the common pool of the family. Then any income generated from the residential house property will be clubbed only in the hands of Mr. A only. Mr. A only. Clear? The family has 3 or 4 members like. Sometimes later, the Hindu undivided family got partitioned. After partition, the house property is now shared. Mrs. A and B, C and D. Mrs. A, B and C. B and C are being daughter and son. B being minor and C being major. D being brother. On partition, the same residential house property shared equally to all the 4. So, A transfers his self-earned property to Huff. Until it is partitioned, any income generated from the residential house property will be taxable only in the hands of Mr. A. After partition, now A has no control over that. As per the partition deed, the property is now shared by 4. Okay, a share is retained by Mr. A. A share is given to Mrs. A. A share is given to B, C, and another share is given to brother. 20% each. 20% each. Now, this remains as it is, no problem. His own share. Probably 1 lakh is earned from the residential house property. In that 1,20,000 rupees is the rent for Mr. A, he can enjoy. What about Mrs. A? That can be clubbed. What about the B? Can be clubbed. What about C? No, it is not required to be clubbed. Now he is independent major. Brother, independent major, not required to be clubbed. This will be taxable only in the hands of Mr. Brother. This will be taxable only in the hands of son C. And Mr. A's in rental income being 20, and Mrs. A and B's are going to be clubbed here. Until partition, the entire 1 lakh is taxable only in the hands of Mr. A. Okay, while transferring year on year, they are getting 1 lakh rental. That rental will be taxable only in the hands of Mr. A. Sometimes later, the property is shared among the 4, 5, 20% each. So, all getting 20,000 rupees each. Out of that 20,000, Mr. A's share will be automatically taxable. Mrs. A's salary will be, rental will be clubbed in the hands of Mr. A, and B's income should also be clubbed because B being the minor. In case of C, major, and D being the brother, not required to be clubbed. Not required to be clubbed. Is that clear? Member to Huff, taxable only in the individual hands for transfer. After partition, if assets given to the transferor's spouse and minor son or daughter, then clubbed in the hands of individual. Assets given to other members are major, no clubbing. No clubbing. Hope now you will be able to understand section 64 class 2. Clear? So all the points are given here. Now, Mr. Todi is a member of Huff? Already I explained. Mr. Toddy. It consisted of Mr. Toddy, Mrs. Toddy, and Mr. Toddy's major son, A. Major, and Mr. Toddy's minor son, B. On 1/4/23, Mr. Toddy transferred his house property acquired through his personal income to Huff. When? 1/4/23. Without any consideration. 1/7/24, Huff is partition and such property being divided equally. Thereafter, it is partitioned and shared to all the members equally. This happens on 1/7/24. Right. So, 1/4/23 to 31st March 24, 31st March 25. Partition happens on which date? 1/7/24. Net annual value of the property being 80,000 and 1 lakh. So 30% can be subtracted. NAV from there, 30% can be subtracted, 24,000, then 56,000, I think. Is that okay? This is 56,000. For this period, the rental being 56,000. Is that okay? Now for this period, 24/25, 1 lakh minus 30%, 70,000. In that, up to the partition, how many months are there? 3 months. 4, 5, 6, 3 months. Thereafter, 9 months. Here 3 months. Here 9 months. For the current previous year, 24/25, the overall income earned being 70. For the first 3 months, how much it should be? 17,500. Thereafter, 52,500. Now, this 56,000, no doubt, taxable only in the hands of Mr. T. This 17,500 is no doubt taxable only in the hands of Mr. T. 52,500 will be shared among the 4. If you share among the 4, what is the value you are getting for each and every member? 13,125. 13,125 will be now transferred and clubbed. Now see, you forget about this year. For the financial year 24/25, okay, up to partition, this 17,500 will be taken only in the hands of Mr. T. Thereafter, 13,125, 13,125, 13,125, 13,125. Because of the clubbing, this will be subtracted and clubbed in the hands of Mr. T. Major son not required to be clubbed here. 13,125 to be clubbed here. How much is going to be clubbed here? 13,125. If old tax regime is chosen, 1,500 is subtracted. What's the final value? 13,125 minus 1,500. Huh? My question is that 11,600. I need to put that value now here. This will be taxable in the hands of Mr. T. Nothing is taxable in the hands of Mrs. T. And here 13,125 is taxable. Here nothing is taxable. Is that clear? Hope now you'll be able to understand. 55,375 is taxable in the hands of Mr. T. Clear? Now we'll move on to the last one, lost aspect. Thereafter, we'll go for some additional illustrations and cross transfers. The entire chapter will be over. Okay, all the provisions are over. One extra provisions to be learned here is all about Mr. A, Mrs. A. Mr. A gives for the Mrs. A's business capital contribution. So Mr. and Mrs. A runs the business with their own fund and amount received from Mr. A. Whatever the income generated, to the extent the contribution given by Mr. A will be clubbed in the hands of Mr. A. That's the same logic. Okay, already we have studied, but here related to the business investment. Let's see. Forget about the formula. I will finish up this illustration so that you will be able to understand easily. Mr. Raju commenced the business with a capital of rupees 5 lakhs in the financial year 23-24. His capital on 1/4/23. 1/4/2023, Raju's capital. Five lakhs. His wife gifted 1 lakh on 10/4/23. 10/4/23. Another 1 lakh gifted by his wife, which was also invested. Additional capital. Mrs. Raju, which is around 1 lakh. Total in the business being 5 lakhs, then 6 lakhs. On the day 1 of the previous year 23-24 being 5 lakhs, matter of 10 days later, another 1 lakh invested, which is actually received from Mrs. Raju. Okay. Now overall capital being 6 lakhs for the year end, 31st March 2024. His net profit for the year being 2 lakhs. The capital as on the date being 6 lakhs, out of which 5 lakhs is Raju's capital, 1 lakh is the capital contributed by Mrs. Raju as gift. Now you have to add the net profit being 2 lakhs. Net profit being 2 lakhs. 2 lakhs profit is earned by Raju's capital 5 lakhs and 1 lakh Mrs. Raju's capital is also there, right? Provided. While clubbing, you have to keep the idea in your mind. The same ratio, 5:1. Okay, that's no problem. But one extra point. The capital balance of Raju and Mrs. Raju as on the first day of the previous year will be the ratio. What's the first date? 5 lakhs and dash. Nothing requires to be clubbed, directly addable only in Raju's capital. Thereafter, the capital being 7 lakhs, 1 lakh, and 8 lakhs. Is that clear? Any profit earned will be shared to Mr. Raju as well as Mrs. Raju. In which ratio? The amount contributed by Mr. Raju as well as Mrs. Raju as on which date? 1st April. Though Mrs. Raju contributed, but not on 1/4, right? So, not required to be clubbed in Mrs. Raju's hand. And net profit for the year 24-25. This is the capital on 31/3/2024. 2024. And for 24-25, again there is a net profit. How much? 4 lakhs. Now the question is, do I want to club? Yes, I have to club. So while any income earned, cross verify in the previous year's day 1. Day 1, the capital being 8 lakhs invested by Raju and Mrs. Raju in the ratio of 7:1. Then any income earned will be shared between these two in that ratio, 7:1. So 3.5 lakhs will be clubbed in the hands of Raju and 50,000 clubbed in the hands of Mrs. Raju. Is that clear? Hope now we'll be able to understand this one. Profit earned will be shared or clubbed. How? Amount contributed as on 1st April of the previous year divided by the total capital as on the 1st April of the previous year. While clubbing, you have to go and refer the 1st April's value. If it is not so, you don't need to club it. That's all. With that, all the logics are over. For the similar one, we'll discuss one more illustrations. The completely over. Thereafter, one comprehensive illustration is there, and we'll finish up with the cross transfers, the entire clubbing provisions by today. Right. Let's now move on to the next illustration. Come on, same way you can try. Ashwin started proprietary business on 24/23 with a capital of rupees 5,50,000. 24/23. Ashwin. What's the capital? 5.5 lakhs. 550,000. His wife Srimati Batma gifted 2 lakhs on the occasion of his birthday. Batma, okay, which is on 28/7/23. 2 lakhs, out of which introduced to the business only 100 rupees, and total being initially they started with 550, another 100 invested as additional capital. Now overall capital being 550 A's contribution, 100 P's contribution, 650 we have. Details of the income for the financial year. So 23/24. This what about the income as on 31st March 24. 1,50,000 being the loss. Now, do I want to club this? Definitely not possible, because as on the day one, only A's capital is there, so not required to be clubbed. The entire 150 is now adjusted only in A's capital. After that, 1/4/24, the capital being 400 for A, 100 for B, P, and overall 500. For the year 24/25, the capital being 4 lakhs. Now, what happens here? It should be shared as per the capital contribution by A and P and 1/4/24, which is 4:1. So, as per 4:1 ratio, 320 will be addable for A and another 80 is addable for B. Hope now you'll be able to understand this. Clear? Any doubts? So that's all. With that, the last provision, investments made by the gift received from spouse. With that, all the logics over. So one of the easiest chapters. You can expect around 4 to 6 marks in this chapter also. Okay, or it will come as a part of the comprehensive illustrations. Now let's move on to the next one. During the previous year 24/25, the following transaction occurred in respect of Mr. A. Mr. A had fixed deposits 5 lakhs in bank account, Bank of India. He instructed the bank of credit the interest on the deposits at the rate of 9% from this period to this period to the savings account of Mr. B, son of his brother, to help him in his education. So now what happens here? He transfers the income without transferring the ownership, then it should be clubbed in the hands of Mr. A only. Okay, this is A's income, income from other sources. How much is that? For one full year, 9%. 9% on this being how much? 45,000. Mr. A holds 75% share in partnership firm where Mrs. A receives commission of 25,000 from the firm for promoting the sales of the firm. Mrs. A proposes no technical or professional qualification. So then substantial interest, then automatically this will also be clubbed only in the hands of A, named as commission only. The same head it will be clubbed. Okay, the value being 25,000. Okay. Mr. A gifted flat to Mrs. A on 1st April 2024 during the previous year. The flat generated a net income. So capital asset is transferred to Mrs. A, and if the income generated, that will also be clubbed only in the hands of Mr. A. Okay, income from house property taxable only in the hands of A. Probably you can subtract 30%, or we assume it is completely computed net income. Net income means standard deductions already subtracted, like you can assume. A given note. Mr. A gifted 2 lakhs to his minor son, who invested the same in the business, and he got a share of income rupees 20,000 from investment. Minor son. So he gives the money, and using the money, any income generated will be always clubbed. So this 20,000 should also be clubbed in the hands of Mr. A only. Mr. A only. Is that okay? Provided if it is being the expertise, no need to club. While clubbing, it will be clubbed subject to yes, deductions of exemption of 1,500. So 18,500 can be clubbed, named as PGBP income. And minor son derived an income of 20,000 rupees through business activity involving application of his skill and talent, requires no clubbing. So minor son account, it will be income of minor son only, no need to club. During the year, Mr. A got monthly pension of rupees 10,000, monthly pension, then automatically it is falling under salary. 1,10,000 in claim either 50,000 or 70,000, 75,000 as the case may be, as a standard deduction. He received salary. Mrs. A received salary of rupees 20,000 per month from a part-time job. So which is 2,40,000 rupees. Of course, he can subtract another 50,000 rupees from here. So the ultimate value being 1,90,000. Now, this income will be clubbed. Which income? Yeah, in whose account it is going to be clubbed? Let's add interest. How much is that? 45,000 will be taxable only in the hands of Mr. A. And this one, commission to be clubbed, 25,000 only in the hands of Mr. A. Gift plan, okay, a flat. So income from house property clubbed here only, the value being 52,000. And 2 lakhs gifted, so will also be clubbed here only. PGBP income 18,500. This is clubbing, and this is not required to be clubbed. And pension to be clubbed here. Pension falls under salary only, so which is 70,000 rupees. This is taxable only in the hands of Mrs. A. This is taxable only in the hands of Mrs. A. This will be taxable only in the hands of minor son. Rest will be clubbed in the hands of Mr. A. What is the total income of Mr. A? 2,10,500. Clear? So let me complete the cross transfer. An additional point, very rarely that question may be asked in your exams. Cross transfer. Clear? I'll directly go for the illustration so that you'll understand the cross transfer theory later on. Mr. A gift 50,000 to the wife of his brother B. Okay. Mr. B, Mrs. B. Mr. A gift rupees 50,000 rupees. For purchase of house by her and simultaneously gift by B to A's minor son. A's son, minor. In foreign company worth rupees 60,000 owned by him. Mr. B gifted 60,000 rupees to A's minor son. What happens, Mr. A transfers to his minor son, then clubbing will be attracted. Safely, Mr. A gives to Mrs. B's spouse and asking Mr. B to gift Mr. A's minor son indirectly, stating that, sir, it's not my income. If you transfer to your spouse, then section 64 will be applicable. Brother says, sir, I didn't transfer. My brother only transfers. Don't question me. Seems to be logically safer, but it's cheating. So this is called cross transfer. Then automatically one new provision is there. As per the new provision, income generated by Mrs. B as well as A's son will be clubbed with Mr. A as well as Mr. B. So any income will be clubbed in the hands of Mr. A. Here also in the hands of Mr. B. Thus, in the instant case, the transfers have been made by A and B to persons who are not their spouse or minor child, so as to evade the clubbing provision. So in order to avoid the clubbing, they have done indirectly. Hence, the income arising to Mrs. B, suppose Mrs. B gets 5,000 rupees and A gets 12,000 rupees. A's son. Okay, from the house property should be included in the total income of B. This one is included in the income of Mr. B. And dividend from the shares, this may be the dividend, also be included in the hands of Mr. A. Transferred to A's minor son. Would be taxable in the hands of A, restricted up to 50,000, lower of the two. So, A's son gets 12,000 dividend, Mrs. B gets 5,000 rupees. For the 50,000 rupees, entire 50,000 invested, no, so 5,000 into 50,000 divided by 50,000, complete value will be clubbed in the hands of Mr. B. But here, 12,000 for 60,000 rupees of investment, but out of that, cross transfer limited to whichever is lower of these two, which is 50,000. Only to that extent of this 12,000 will be clubbed. Maybe 10,000 is going to be clubbed here. This is called cross transfer. So, cross transfer is a case refers to transfer of assets by a person to the another person in return for transfer of the assets by another person or his relatives to the original donor or his relative indirectly. This is called cross transfer. Clubbing provisions will be applicable only to the extent of income on the matching amount of the cross curve. Matching amount, not 60 for 50. Okay, between these two, matching amount is 50 only, not to that extent of income only required to be clubbed. Is that okay? That's called cross transfer. So, with that, all the concepts are over. Let me finish up a summary regarding this. So, transfer of income, automatically transferable, taxable only in the hands of the transferor. 61, with the revocable, then automatically taxable only in the hands of the transferor, except revocable after death, then this will not be applicable. In case of irrevocable, always taxable only in the hands of the transferee until it is not transferred, until it is revoked, okay, until transferor reassume the power. And section 63 is all about definition related to the transfer and revocable transfer. Section 64 clause 1, where subclause 2, substantial interest, due to the substantial interest, spouse gets employment without any qualification, then it is going to be clubbed in the hands of the person who is holding the investment. And 4, 6, 7, 8, spouse or daughter-in-law, son-in-law, sorry, father-in-law or mother-in-law transfers the asset to spouse benefit or daughter-in-law's benefit directly or routed through any person or association of person will be clubbed. Is that okay? That we have seen. But their relationship should be exist at the time of transfer of the asset as well as at the time of generation of the income. Okay, these are the cases we have studied. And minor child case, you have to club with the parent's income, whose income seems to be higher than the higher before clubbing, before adding this income. In that parent's amount, it will be addable. Okay, subject to a deductions of 1,500 in case of default shifting out of the default tax regime. And member to HUF and after partition also we have discussed. So if the asset is transferred by the member to the partner, it means the HUF, it will be taxable. The income is from that is taxable only in the hands of the member. After the partition, if the asset again comes it back to the same transferor, then it's taxable, no problem. Transfers to some other members, being the spouse or minor child, clubbed, otherwise not required to be clubbed. We have seen that. And clubbing includes liabilities also. Here, additionally, what the point you have to note here is and business investment. Business investment. And you have to understand one more theory called cross liability. With that, all the content is over here. Clear?